I've seen a number of changes over the years, and I've seen the SRA's approach to residual balances hardening over that time. I can remember a time when the concept of residual balances didn't even exist. And I can remember when that concept was first introduced and some of the confusion it caused back then. Now, in many cases, the reporting accountants have been flagging these residual balances to firms for a number of years. And from my experience, if there's one thing that's going to make a reporting accountant issue a qualified report, it's where they raise an issue to a firm that the firm needs to sort out, but it's still there the following year. And out of all the breaches that I've seen in my time, residual balances, and in particular the lack of activity in dealing with them, that's been the common recurring theme across most law firms that I've dealt with. Now, I should say I've never seen that happen. I doubt the SRA would have the time or specialism to make that kind of assessment. But yeah, it is a possibility. So I think the sensible approach with these is to cover those bare minimum steps. So use the DWP, use the free searches, and for some larger amounts, put the advert in the paper. Because I think it's unlikely the SRA is going to have an issue with those, unless, of course, you're putting a centre page spread in the Financial Times. Now, when it gets beyond that, when it gets to the point where you need to take further steps, I think that's the point you should make an initial application to the SRA, because they're either going to approve it or they're going to reject it. And if they reject it, they're presumably going to tell you why they rejected this and what steps they want you to take to deal with that. And then if there are any costs involved, I'd almost take that as pre-authorization. You're probably wondering, why do or where do residual balances fall into the banking facilities umbrella? Now, I'm not going to bore you with too much detail, other than to say there was something in the old 2011 rules that said that if a firm was holding on to client money and there was no ongoing legal transaction, the firm had an obligation to write to the client at least once every year to inform them the amount they were holding, how long they'd held it, and why they were holding it. Now, for most firms, that obligation meant it was much easier to return money to the client than it was to hold on to it. But for firms that held old residual balances that they were struggling to deal with, they interpreted that as meaning that as long as they wrote to the client once a year, then that was their obligation sorted. And in fact, some firms still think that. But that's not true. It wasn't under the 2011 rules, and it isn't under the 2019 rules either. And that certainly applies where you don't actually know where the client is, because, it's just pretty clear and dealt with residual balance.